Hello everyone, and this video is to give you a quick overview of Scorp. I recall the business taxation from chapter 15. The Scorp is election for tax purposes. The corporation is formed the same way as the C Corp. The corporation is the default as a C Corp unless an S Corp election is made. Um, from a contribution perspective, from a formation perspective, the section 351, non-recognition of gain loss still apply, and shareholder stock basis and debt basis are maintained separately for S Corp shareholders. That's something that's a little bit different from the partnership. And from a reporting perspective, similar to the flow-through entity partnership, there's an entity level reporting which is the 1120S. And at the entity level, the S Corp has to determine the election of the S Corp, and also they can terminate the S Corp election status. And we may end up a short tax year for the S Corp due to the election. And the termination of S Corp status could be voluntary or involuntary. Due to this hybrid nature of the S Corp, in some instances, the S Corp could incur some corporate level tax, which is the covers the LIFO recapture tax, built-in gains tax, and tax on passive investment income. So those tax only applies uh, if the S Corp was a C Corp in some of the periods. So it requires a conversion from a C Corp to S Corp. But if the S Corp is set up or is elected on the first day of the corporation, then those corporate level tax will not apply. And the shareholder level, similar to the flow through entity partnership and 1120S, there will be income loss allocation and the basis adjustments um, are required to be updated every year. Consider the income loss allocation. And the loss limitation rule still applies, similar to the partnership of the basis and at risk amount. Those hurdles are applied at the entity level for a specific entity. And the distribution to the shareholders, including the liquidation distribution as well as non-liquidation distribution, have a similar treatment as the C Corp in a sense. So again, the chapter 22 pretty much covers all the aspect of the S Corp taxation. It's a kind of catch-all, and there are some characteristics are mirroring the C Corp, and some of the characteristics is mirroring the flow-through entity. Really, the S Corp is fundamentally is a flow-through entity, but however, it carries over some of the characteristics from the C Corp. The S Corp status elections and terminations, there are some specific requirements for you to read through. And accounting methods and periods, the same thing. If something happened at entity level, and income loss allocation are done in a pro rata way and based on the shares owned each day of the year. So if the shares were sold during the year, a pro rata per day allocation will be applied. And so there are some income loss allocation, special allocation rules applied if there's ownership change during the year. And employment tax and the fringe benefits, this is something is a little bit unique for the S Corp. The shareholder's salary are treated as a payment to employees, and it is subject to Social Security tax or the payroll tax. And the S Corp's shareholders' allocable share of ordinary business income loss is not classified as self-employment income. So this is very different from the partner's allocable share of ordinary income loss, because at that point, the allocable share of ordinary income loss is treated as self-employment income, will be subject to the self-employment tax. The fringe benefits, this is something, it's similar to the fringe benefits at the corporation level, and but the treatment is different depending on uh, the ownership percentage. For shareholder employee who owns 2% or less of the S corporation, the S corporation gets a tax deduction, and the benefit is not taxable to the shareholder employees. In that sense, it is very similar to the C corp. And for shareholder employees who own more than 2% of the S corporation gets a deduction, but benefits are taxable to the shareholder employees. So this is similar to the treatment of the flow-through entities. And some of the common separately stated items on the K1, so this is similar to the 1065, this K1 common separately stated items, including any items which could really trigger a different tax treatment at the individual shareholder level, such as short-term capital gains losses, long-term capital gains losses, Section 1231 gains losses, dividends, all that. And from a shareholder perspective, the shareholder stock basis is separate from the debt basis, which is different from the partner's basis tracking as well. Because at the partner level, the stock basis and the debt basis are kind of combined in a sense. And for shareholder stock basis, any additional contribution or income allocated will increase the stock basis. Any distribution or non-deductible expenses or loss deductions allocated to the shareholder will reduce the basis. Similar to all the basis rule we have seen before, the basis cannot go below 0. And the basis in debt is tracked separately. It starts with initial loan from the shareholder to the corporation, then increased by additional loan, and reduced by the loan repayment or principal repayment. Finally, we get to the core of the S Corp, really a big topic on this for this chapter is regarding the characterization of the distribution allocation from the S Corp. So because the unique nature of the S Corp, because S Corp could be a C Corp, because the S Corp election can be done after the corporation is set up. Therefore, there could be some carryover characteristics from the C Corp time period. So therefore, from a distribution perspective, there is a kind of a mixed of the pools or the basket the corporation the S Corp has to track. So from a distribution perspective, the distribution will be treated as distributed from the cumulative adjustment accounts. This is the cumulative adjustment accounts are similar to the cumulative earnings and profits concept, but those are during the years the corporation is an S Corp. This AAA account is really earning and profits for S Corp only. And then the second basket is prior year C Corp, CEMP, and the last one is other adjustments account. So there will be some tax exempt income and related expense at the S Corp period. And finally, we'll get to the stock basis. And really, the reason why we set up those different buckets is really to try to capture any distribution should have been treated as a taxable dividend during the C Corp period, because when if the corporation is set up as a C Corp first, then later on is switched to S Corp status, then any distribution out of the C Corp E&P should be treated as a taxable dividend. It will follow the C Corp distribution rules. So that's why the different buckets are maintained to ensure the proper characterization of the distribution, the X Corp distributions. And similarly, if the distribution is coming out from the cumulative adjustment accounts, the effect on the shareholder basis will be reduced the basis. And for prior year C Corp E&P will have no effect on the basis, and other adjustment accounts also reduce the basis and the stock basis. If any stock basis distribution to the extended basis will be tax free, and any distribution in excess of the basis will be taxable as a capital gain. And from the corporation perspective, all the distribution will not be deductible. And this is a quick summary of the AAA, the accumulated adjustment account balance, how to track those. Those are separate pools, similar to the E&P. So basically, just any separately stated income or income minus the losses. Any distribution out of AAA will reduce the AAA balance. And the last section of the chapter, covers the distribution. Similarly to the distribution we have talked about in other chapters, the distribution, really there's two layers. One is the liquidation distribution, the other one's the operating distributions. And what we have here is, when we start with this table here, we're really starting with kind of the default, the cash distribution. The property distribution, why it's always singled out, is because the property distribution, there's an additional twist, is the fair market value of the property on the date of distribution has to be determined, because for cash distribution, cash is a commodity, everything is pretty clear as far as the value. But for a property distribution, the first step is to determine the value. Plus, you have to consider any liability associated with the property. And so, if there's any debt relief on the property distribution, then that debt relief will reduce the fair market value of the property distributed. And from a S Corp perspective, because whenever the distribution of property distributed, it's treated as again a transfer of property. Any gain or loss or recognition will be need to be considered. So for S Corp purposes, any gain recognition will be required only on the appreciated property, but there's no loss recognition. And the S Corp AAA will be reduced by the fair market value of the property disputed, because any property distribution is similar, it's treated as a distribution of value. And the shareholder tax implications, the shareholder stock basis increased by the share of a gain recognized and decreased by the fair market value of the property distributed. And the recipient shareholder's basis in the property distributed is the fair market value of the property on the date of the distribution, because the gain loss are fully recognized. So liquidation distribution, generally speaking, the S Corp will follow the C Corp rules. The S Corp will recognize the gain loss on each asset they distribute in liquidation. And the gain loss are allocated to the S Corp shareholders and increase or decreasing their stock basis. And finally, the entity level S Corp, If it's previous S corp is a previous tax is C corp. This is for your information only. We will not have any calculation based question on those. Just this is just for your information. And finally, just like all the other entities, we're going to look at the estimate tax payments and filing requirements. What is the tax form and what is the extension? All that. And the last is regarding the post-termination transition period distribution. There's a special rule. This special rule is really to consider any S corp later on decide to switch back to a C corp, and the rule is designed to ease the transition from S corp to C corp status by allowing shareholders to benefit from the corp's prior status with respect to certain distributions. And generally speaking, the PTTP, the post-termination transition period, generally begins on the day after the last day of the S corp's final taxable year, and ends on the later of 1 year after that last day, or the due date for filing the return for the last S corporation year. So the PTTP could be more than a year. So the cash distribution during the PTTP are tax-free to the extent they do not exceed the corporation's AAA balance and the shareholders' basis in the stock. And also the shareholder has an option to elect to distribute earnings first, rather than enjoy the benefit of the tax-free distribution, depending on their circumstances. And there's a lot of calculation going on here regarding the S corp. We're gonna only single out a few in our homework. For homework 57, question 57, this is a loss deduction limitation question. But really, we're just looking at the basis, loss deduction related to the basis. And there's different scenarios. I already kind of did the calculation for you. The question for you is you want to kind of read the rules and laid out, expand on what are the loss deduction limitation rules overall, not only the basis limitation. And the hints here is really for you to have a good understanding or overview of what is the loss limitation rules regarding S Corp. A good resource for this section is your chapter notes. You can copy the whole section of the chapter notes regarding the loss limitation rules here, because that be your hints. For the reflection, this is something you want to take a look at the calculation and just have some takeaway from this calculation and see, why the calculation is done this way, and how you can learn from this calculation. Some of the formulas built in here. Why we use minimum. Why sometimes we use different formulas in different roles, and what's the purpose of this calculation. So reflection is something is after you have done the calculation, and try to figure out what is the takeaway. And the 69 sections, question 69 is regarding a distribution from S corp. So in this case, we're just dealing with cash distribution, and we're not getting into the complication of the property distribution. And again, the different scenarios for the same S corp. So take a look and see how this calculation is done, and populate the hint section as well as the reflection section. And for the last part, the three tabs is basically kind of build a simulation for you, so you can see how the S corp cash distribution are characterized by the different layers. You will see how this is done, and from the calculation perspective, at what step the calculation is applied at corporation level, and at what step the corporation is done the calculation is done at the shareholder level. So this is a simulation for you to take a look, and you can also use those templates while you're reading the book regarding the various distribution as S corp level. So again, the 3 tab is for your information: operating cash distribution, and operating property distribution, and the liquidation property distribution. So for your information. Okay, so this should be all, and thank you for listening, and have a great day.